I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. Let's look back at what happened in the financial markets in the past week. And I look forward to what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market chopped widely in a holiday shortened week, making a low on Tuesday and then gaining footing after that, mostly on a report that came out that the AAII sentiment survey said that bulls versus bears were 18.1 to 53.3%. This was a very bearish reading and gives you some sense for the fact that, well, traders certainly and investors had turned very negative. That means that they already sold or were short, and then when the market started to go up, they began to chase it. Also helping was a dollar that had been very strong and a yen that had been very weak. Well, that hurt the market for a while, but now that reversed here later in the week. Also, of course, the market watching interest rates and all of the Fed speak that's been going on. So that had investors very worried, but then again, this really negative sentiment brought buyers in. That really followed our projected pattern where we expected an early week low, and that happened on Tuesday, which was the first day of the week, and then Wednesday the market started to move up. It really went up all day with the S&P 500 gaining 77 points. So that was a very strong day on Wednesday. Thursday, starting out the day, the ECB raised rates by 0.75%, and Powell, he was interviewed by the Cato Institute, and that really had the market wildly moving early in the day. In fact, for the day, the S&P 500 was starting out minus about 38 points, rallied all the way up to plus 28, fell back to minus 24 points, and finished the day up 30 points. So talk about wide chop. We really saw that on Thursday. But getting back to Powell, and he really pissed me off. He abdicated responsibility, saying that the pandemic caused the inflation. And without it, there wouldn't have been this inflation. Well, that is one of the most absurd statements I've ever heard because, of course, and I'll talk about it a little bit later, the Fed had been in the Great Experiment for all the way back since 2008. So we're looking at 24 years of Fed irresponsibility, and that's really what caused the inflation we saw now, especially with all of the government spending. So that really was a really scary statement by him. He said also that the dual mandate served the public well. Well, how about 24 years of boom and bust that we have seen and a $30 trillion national debt? How exactly did the dual mandate serve the public well? Another just horrible statement. And he said, of course, that the FOMC is strongly committed to controlling inflation. Well, how exactly did he do? Let's take a look as we look at this slide really quickly. And what I want you to see is that the inflation rate that we saw way back over here, which had climbed to over 14%. Well, when you look at what happened in here, back here in the 70s, that high inflation was caused by, well, Nixon. He took us off the gold standard in 1971, right back over here. And then Carter responded to the struggles that Burns was having controlling inflation. And in 1978, he put on wage and price controls. So those were two really horrible things that these two presidents did. And that brought this big inflation right over here. You can't put in wage and price controls because eventually they are going to spike when you take those off. And that's what happened. So heaven forbid we should get anything like that right now. Of course, this Fed is avoiding that. But let's take a look over in this period over here. 2008 all the way through the period we were right over here before the pandemic. And this was a period where inflation was, well, it was fairly, steady around that 2% area up and down. This big drop right over here in inflation, you see, to just over minus 2%. That was the Fed, that was the bubble, the great mortgage bubble deflating. So they caused all of this. And so what if they're paying a little bit less money? So what if the consumers can benefit from that? And here you could see all of this period here of inflation that was not a big deal. Yet, an average inflation rate of about 1.7%. They said, well, they want to control inflation, just like they're saying now. They are committed to it. Well, how did they do? They did horribly. As a matter of fact, they and the government, the FOMC and the government, caused this huge spike in inflation right over here. If they would have just, helped the people in a small way, make sure they have food and make sure that they have a place to live, then and not do all of this huge expansion, we wouldn't be in the huge trouble that we were in right now. So all of that that you see in here, Greenspan in this period right over here set up the huge bubble that we saw in 2000, and Greenspan began this activist Fed who has caused this right over here. So when you hear something from Powell that comes out and says that that they are committed to controlling inflation, well, they were committed to it at 2% before, and they are causing the misery that you see right now. So I couldn't get by without that rant with the ridiculous statements that he had made there in that Cato Institute interview. I think that there will be a Congress in the future that will change the mandate. They have to do that. I say it should be arranged that the Fed cannot act if inflation is, unless inflation gets under 1% and maybe over 3.5% or 4%, they have to stay out of the market. And the same thing for employment. Right now, employment is at unemployment at 3.6%, which is way under what full employment used to be. I would say that they shouldn't be able to act unless employment moves under 3.5%, which would cause them to tighten, or maybe over 5.5%. So that would keep them out of the market, and you wouldn't have all of this fine tuning. But that's just me, and I would support people in Congress that brought that. So I wanted to share that. It was time for a little rant, and definitely Powell got me started on that. So Thursday, we had that big recovery again, where we had up well over 100 points off the lows. And then here on Friday, we saw a gain of over 58% in the S&P 500. Again, the shorts got stimulated to buy by a big break in the dollar that we saw today as it moves off the peak. And that had the NASDAQ bouncing very significantly, which had been very depressed. The tech stocks have been under pressure. It also got the commodities moving up, which has helped the material stocks. And oil has rebounded about $2.50, but we think it's in trouble. I'll speak more about that in a little bit. And Arby is going to show you some analysis on light crude coming up. So let's talk about the stock market. The stock market, well, it's in terrible shape. It's been that way for most of the year, and we keep warning about that. Let's take a look at our proprietary Slimulator Momentum Tracker, which has a 3 to 6 month outlook. This is for position traders or longer term holders. And this is a great tool that we developed. That's the Slimulator Momentum Tracker right there. And what we show you here is all different kinds of canned groups that are in here. And I really want to look at right now these world ETFs and how we get some information about that. Remember that we have been talking about the European markets, the world markets, leading the U.S. stock market to the downside. You can see in here that we have an investor outlook essentially for 3 months plus. And what we give is the conditions of the market here and what our directional bias is. And then you can see the long-term, intermediate, and short-term momentum conditions. This is the directional bias ratio, which essentially says that when you look at everything in this group that we're looking at, which is world markets, that 86% of them are negative on this 3 to 6 month outlook, and only 14% are neutral. There are no positive groups there. So what I want to do is I want to scan here on directional bias, and let's take a look at the very bearish. You can see in here the EEM, the SPY, IWM, EWJ. Those are all very bearish. QQQ, Russia, the stocks 50, the FEZ, EWG, which is Germany. And you can go all the way down here. There's China at very bearish, and all of those, the diamonds, which are of course the Dow Jones, very bearish. And that's how they have been, and it's still set up that way. If I take a look at the EEM, you can just get a sense in here as I put up the chart of the EEM, and you can see in here that it has been negative for quite a long period of time. In fact, way back here at the beginning of the year, it was very negative. You see that big downside arrow there. It's gone from a little bit negative to very negative all year long, and you can see that it kept you really on the defensive side if you were a longer term holder, and keeps you from buying it. So you can see in here, looking at the emerging markets, that that is really quite a negative condition that it had. And there's really nothing in here. If I switch the directional bias to the most positive, is only slightly bearish to neutral, as you can see, and Brazil is in that case, Mexico. So this is some pretty bad readings that you see in here still for the world markets. Let's look a little deeper into the U.S. market as we switch here into the groups. Let me get down here to the groups, and we can get the spider selects right over here. So you can see in here, if I look at the directional bias, the XLU, the XLE, they're bullish. These other groups in here, very bearish when you look at the financials, XLF, XLV, the healthcare, XLY. These are all very bearish in here. The communication stocks, which are techs, really very bearish. The materials are slightly bearish. The XLP is neutral, and you can see that that is a really overall pretty negative condition. Let's take a look at which has been the strongest, which has been the XLE. Let's just look at the chart in here of XLE, and you can see as I put that up, that XLE has been positive and kept you on the long side, saying basically this is the group you wanted to be long, and short or out of the other ones, because this has been positive the whole time. So you get a good sense when you look at that, looking deeper into the conditions of the market, what the market really looks like, and how you can use this type of a tool, Slimulator Momentum Tracker, to give you a really better sense for the market. So I wanted to show you that. I wanted you to see the world conditions are really still very bad, and there aren't any really great groups in here except utilities, which are defensive, and also here the XLE, which is still on the positive side, despite the fact that oil has had a very big drop in there. So that's, I thought, was important to look at. It's going to take a lot of work for this to change, and the stock market to get in any better shape. That could take many months. And ahead are probably many failed rallies like we have seen. Investors will still be guessing when the bear market will bottom or how low. Our sense is that it will be breaking that low of 36.36 in the S&P 500. That's very high odds, and maybe 10 to 15% lower. Our target and timing remains out in March of 23 for the best hope for a real bear market low, and that could be plus or minus a month based on our work, and that of course could mean that the market has a lot of problems going forward. And I showed you that looking at really these longer 3 to 6 month holding periods. That's actually a great tool. You could become a level 1 member. We're having a special right now where you get the momentum tracker and our daily stock index and some other great stuff. The snapshot for the stock indexes for $10 for a month. So sign up for that. Just go to the top of the front page and you will see that. So just wanted to show that all to you. It really looks like, of course, the market is in very bad condition. For the week, stocks, well, they gain over 3%. The bond market, it loses about a point in the 30s. I think a rebound is coming here in the bond market, but it's going to be minor probably, and likely going to see trouble again in the bond market. They have some short-term breakdowns that are very worrisome. And the 10-year yield's up about 8 basis points on the week, around 3.27. And I think that high up around near 3.5 is going to get tested again before this real weakness we're seeing in the bond market is over with. Gold market, there was a small rebound, and we saw maybe up about $5, and that the metals market still needs to do some work to make this bottom in there, though they are getting away from a trouble area. Silver added 70 cents or more, so it's acting a little bit better. The dollar, it peaked at 110.78 this week. Our target was 111 or more. And we still think there's a good shot at 111 to 112 after a minor pullback in here, which takes the dollar up into late September. The oil market, well, we were looking for a target of 103 to 111, but then it had a breakdown. So we have downgraded it, and that target now has been lowered. If you want to see that, you can watch FutureSpeak, which has all our commodity analysis in there for weekly and daily, and shared some of the evidence on all that. So for the oil market, we think now a rebound is likely to fail, and it probably has some struggles coming for a long period of time. Coming up in this show, Arvi is going to bring you a member video preview where he's going to show you FutureSpeak, multiple time frame analysis in crude oil, which we believe is now negative. Katie is going to share cycle analysis with options. This is a new video that we offer out. She's doing analysis on Amgen, which has a negative bias, and applying option strategies that fit that analysis, and you're going to find that to be very interesting. And of course, we are now featuring her using the Tastyworks platform, which is really the premier platform for option trading. We're also beginning a level 1 special, $10. That's a 50% discount for our Slimulator Momentum Tracker, daily stock index report, and more. I'll show you some more about that coming up in a little bit also. And I'm going to bring you stock market short-term analysis, looking at the SPX and expecting a bounce, and that came. And now we think that there will be some pretty good amount of trouble to follow. So the stock market analysis is coming up. Be sure to go to the askSlim website. You can become a free member or take advantage of our new $10 offer for level 1. That is just an amazing offer. If you're on YouTube, subscribe to the channel. Click that notification bell and do like this video. Give us a thumbs up. On Twitter, follow us at askSlim. And for questions about our memberships and specials and our huge offering of education and analysis, you can write to Matt at askSlim.com. We are the premier site for support for traders and active investors. This is a preview of a member video. We do FutureSpeak video every Wednesday. I spend a whole day working on all of the analysis on all of the 24 commodities and indexes that we look at. I then send that analysis in weekly and daily charts over to Arvi. He reviews it and then does the FutureSpeak show, which is about an hour video with some of the best lessons on analysis and projections that you will ever see. This is just a taste of that, looking at light crude, which is right now giving us negative indications. Take it, Arvi.
So this is the weekly and daily grid for CL with the weekly on the left, daily on the right as usual. If we look at the weekly chart, I'm going to zoom in here because I just want to make sure this is clear for you. We had a key intermediate term low that was due to form. Now, was this the low and then we had a 2-week rally and now a breakdown? That would be a very negative situation because it would imply that there's further downside risk going all the way into early January of 2023. The other possibility is that this low that we thought formed the week of 8/15 has pushed out just by a few weeks. So we just have to keep our eyes on that possibility. But currently, some of the evidence is favoring a bearish weekly bias here in /CL after a key high that formed the week of 3/7 right there. You can see after that we made a lower cycle low versus that prior low, and now what looks like a lower high versus that old high, and rolling back down. So this is a period of heightened downside risk here in CL as we get out into the early part of winter and towards the end of this year. That's that period of heightened downside risk where we will look for any little uptick to fail and then lower low. So not a great picture overall in CL. If we go ahead and shift to the daily chart, I'm going to zoom in here so this is clear for you as well. We have this dominant cycle, which is then broken up into minor halves. We've traced out how the minor cycles have formed over time, and this is that daily cycle breakdown that we had just mentioned to you, where the high formed on the left side of the cycle, and we are in what we would call a left-hand translation likely for the rest of this cycle. Now, that is only valid as long as we hold below this key high here at 97.66. But if we look at it right now, we have a bearish slim ribbon and a daily cycle breakdown. Short-term bias here in CL is negative. Upticks are likely to fail until we form that next mid-cycle low on the daily, which is due around the 9:20 time period. So we have a short side bias here in CL based on this weekly and daily cycle analysis here in crude.
Really great job on that. Thanks, Harvey. This cycle analysis with options, Katie's going to look at Amgen, and she brings great analysis, and this is really a great lesson on cycle analysis, suggesting that there are negative conditions in Amgen. And she's going to show you a couple of strategies that you could use, just as an example, setting up option strategies using the Tastyworks platform. So I think you will find this very interesting.
Hi, this is Katie with askSlim. Today we're going to demonstrate setting up some option strategies in Amgen, which is found in the bottom confirmed category for the daily time frame on our cycle low timing tracker. Bottom confirmed means that a symbol has exhibited enough positive price action out of the cycle timing window to trigger that algorithm. But that positive price action doesn't always mean a bullish setup. Notice these two red squares next to the Amgen symbol. Those red squares are letting us know that in both the intermediate and short-term time frames, conditions are negative as represented by a combination of cycle phasing and momentum. Now let's go over to the chart of Amgen and take a look at the analysis. This is a 5-year weekly chart of Amgen. The cycles are an average 27 bars in length, represented by these cycle brackets on the bottom. These purple spikes show where the actual cycles made their lows. So the last cycle made a low right here and then moved up. Amgen basically retested that recent high and then moved back down, nearly retesting the cycle low support. So we have just been chopping sideways between those levels. These blue vertical dashed lines over here on the right represent a period of a few weeks around the ideal cycle low, when we expect this current weekly cycle to make a low. Now that period of time is from October 31st to December 9th. We show momentum on our weekly charts with our proprietary reversal scout, this green and purple ribbon. As we have chopped around, it has been switching direction. It is currently negative. Over on the daily chart, we have recently come out of this daily cycle timing window between the blue vertical dashed lines where the prior cycle made its low right there. Now, that cycle was negatively configured, meaning that it ended lower than where it began. So the probabilities favor not being able to make a new high in this cycle. You can see our projection is to get up to the top of this resistance zone at about $248, possibly the 78.6% fib at $250.70. Momentum is currently negative with both the reversal scout as well as the slim ribbon, another proprietary momentum indicator that colors the candles green, gray, or red depending on momentum conditions. Now, those conditions may neutralize if Amgen does continue to move up into the top of this resistance zone. So let's summarize all of this in order to come up with a directional bias for an option strategy. We have sideways chop on the weekly chart with a negative reversal scout and a weekly cycle timing window expected to begin at the end of October. We have negative momentum on the daily chart, as well as a prior cycle that was negatively configured, currently in the resistance zone with the next daily cycle timing window expected between October 3rd and October 11th. This generally suggests a short side bias going into the October timeframe. So let's switch over to Tastyworks. These are the available expiration cycles in Amgen. We'd like to avoid earnings. That's this purple ribbon on the Tastyworks platform. Earnings is November 1st. So in order to avoid that, let's just choose that October monthly expiration with 43 days to go. The implied volatility in that cycle is 23.2% with an IV rank of 38.2. Kind of middle of the road implied volatility, we could consider short premium or long premium. Let's start with short premium. Our prior cycle peak on the daily chart is at about $255. And because that prior cycle was negatively configured, the probabilities favor not being able to take out that level. So we could just go in and sell a naked $255 call. Now you'd collect $3.25 in credit, but you're using almost $4,000 in capital and have infinite upside risk. In order to mitigate those conditions, we can purchase a further out-of-the-money call to define our risk, thereby creating a call credit spread. Now, you can make this as wide as you like, although if you go over 40 wide, then you'll actually be using more capital than just selling the naked call. So let's look at a $10 wide spread. We collect $2.15 in credit, and we are using $785 in capital. That's our max loss. Now we have a probability of profit of 75%. We pick up 16.5 short deltas and a daily theta of $2.65. Your break-even point is at $257.15, which is above even the prior cycle high. So that being the case, you could move this whole thing in a strike to the 250-260 call credit spread. Now collecting $3.30 in credit with a max loss of $670, which is also the amount of capital that you would have to put up to put on this trade. Your probability of profit drops to 69%. Your break even now is at $253.30, which is just less than $1 below the prior cycle high. Let's talk briefly now about long premium strategies. We are in this resistance zone on the daily chart, which is a good entry point. But I'd also like to wait for the slim ribbon PO to give a momentum continuation signal to the downside and or to have the reversal scout on the 2-hour chart turn negative before placing the trade. At that time, you could go over to the put side and set up, for example, a long put spread by buying 1 or 2 strikes in the money and selling 1 or 2 strikes out of the money. I try to get the max profit, max loss ratio as close to 50% as possible. In this case, your max loss is a 555 and your max profit is 445. Because that's less favorable on the profit side, your probability of profit is 62%, somewhat greater than 50-50. That's the give and take in options. If we move this whole thing to the 250, 240 strikes, then your max profit is 575 and your max loss is 425. So since your max profit is greater than your max loss, that brings your probability of profit closer to 50%. So that is our demonstration of using the analysis to set up short premium strategies as well as a long premium strategy in Amgen. We demonstrate and follow various options trade ideas each week at askSlim. If you'd like to learn more about our tools and services, please visit our website at askSlim.com.
Super work, Katie. All right, stock market analysis. I'm going to look at the S&P 500, but how about the askSlim daily analysis for $10 for a month? Well, here's how you get that. This is our askSlim Level 1 special. It's 50% off for 1 month. You'll get a great taste of some of the things that we do. You're going to get the key things, a stock index report. This is our daily SIR. Matt does just a phenomenal job sharing the analysis on the S&P 500, NASDAQ, and the Russell. It's slim charts with our cycle analysis on it, projections, and key levels. And there are many more things that are in there. The Slimulator Momentum Tracker, which is for investors and position traders, over 1,000 symbols, and there are canned groups in there with our proprietary algorithms built into it, and you're going to get directional bias and momentum for people that are a little longer term holders. I illustrated that earlier in the show, so if you're just watching this and you didn't see it, please go back and watch the beginning of the show. The Spider Select ETF weekly review, where you're going to get information on important market sectors. Plus, we have great resources in Level 1 for trade planning. Use our worksheets and gain access to our Discord server, where you can get a lot of support. Go to the askSlim.com, top of the page, and click on that Learn More. When you do that, it's going to take you to a lot of description of what is in this special Level 1 for $10. And you can write to Matt at askSlim.com if you need some more information about that. This is just amazing information that you're going to get. Can you imagine? Just $10. Go ahead and go to the askSlim.com site if you've never been a member or you're a free member, and sign up for Level 1. All right, stock market. We're going to look at the S&P 500 short-term view for the next 1 to 3 weeks. I did that last week also and gave you an indication that I thought that the market would bottom either at very late last week or early this week, and then there would be a rebound, and that rebound would be setting up another pretty good decline for the stock market. So I want you to see what our analysis looks like, but let's take a look first at what analysis looks like if there were none of our annotations and without our cycle analysis. Well, what this has is the slim ribbon, which I can describe to you very quickly as a 3 different moving averages in here. And this is available for free for several different platforms. If you want more information, write team at askSlim.com. So you can get this to put on the Thinkorswim platform or some others. Then on the bottom is a proprietary indicator, which is the Slim Ribbon PO, which gives you a sense for momentum and changes in momentum or continuations in momentum. As you can see in here where the market was going down, you were getting those continuation signals and it was red. Here Here, when the market was going up, it gave you a continuation symbol. And here, when the market is rallying, this is still red and about to give a continuation signal on the downside, I believe. So this is without our annotation. So wanted you to see that. But now I'm going to bring in the annotations that we show to our members. And of course, you could get this by becoming a level 1 member or higher. Anybody who's a premium member has access to some version of our charts. So you can see in here now the energetic motions of this movement in here are now visible, and we show this analysis. Here on the bottom, you can see the cycle brackets, and these are a drawing tool, and we just use these to understand money flow that's going on. And when you get negative cycles, and this is the actual cycle here, this is the ideal cycle, and you can see the bottom here in that yellow area is where the downside risk is. You could see that here and here and here. This is the money flows out. And if the market was in good shape, the configurations on these would be higher highs and higher bottoms. When the market is in bad shape and there's negative energy, it's lower highs and lower bottoms, as you can see right in here. So now I'm going to zoom in right at this point, and you can see these last couple of cycles in here. And we talked about this one right here, where it really would not decline and how that was positive. And even though we had looked for it to get into the buy zone over here, and people would write to me, "Hey, Slim, you said it's going down there," and I was waiting there to buy it. But well, it was too strong, and you can see the slim ribbon strengthen here as it kept widening out to this area, and the slim ribbon PO with the positive signal, and then things began to change. You got the break, you got the failure in the sell zone right over here, which was perfect, and then moving down. We thought that this minor cycle would bottom and we would get a rally from the end of last week or early this week into this area of resistance, which is the sell zone. And you can see the market right now with the S&Ps up 56, actually getting into that lower portion of it right over here. So this level right over here was about 40.52. This level here is 41.04. So that would really be the area that I would think would be consistent with the market turning down again, because we have this big area of risk where this yellow oval is. And again, because this is negative right over here, negatively configured, and this is called a left-hand translation, where this cycle peaked way on the left side with all this time left to fall, it says that the highest probability is it will fail in here. You know, there are things do change, and when I say highest probability, I would make it 70-80%, but that leaves 20-30% where it would get above this level right over here, 41.55, and then make us look real hard at what's going on. But we think that is a very low probability. Then what comes into play is the failure in this area, which should come sometime next week, and then the market moving down. So the question is it going to test this area of 36.36, which was that last low in June, or will it get support around that last low, or there's some support in the middle over here, so in the 3700s. That's, in my opinion, falling back underneath this cycle low right over there is practically a given. That's 38.86. I think that's very, very likely. And potentially getting down to that last low 36.36 before this is over with over here. So we're in a period where it should be rallying, and it is rallying. It's getting into resistance, and it will peak somewhere in here, probably right in this area right over here. And then when the sellers come in again, this is a very dangerous time frame. Now, it could get under 36.36, or it could just pull back to this last low over here. We don't really know. We just know that this is a period of risk, and that in this period there is a high probability that it will be moving down again, and down potentially in a very serious way, just as you saw in these last few cycles right over here, where there was that big decline after that failure right over there. You see the minor cycle rally in here, and then it ended in resistance and then had a big sell-off. That big sell-off is due right over here, and this is not a time to be buying the market. There's likely to be a better time coming up to buy the market, and that would be sometime probably out in the late September to early October time period. You see this vertical line right over here and this vertical line right over here. These are time cycle lines, and the low is due to come somewhere in the middle. The ideal low is right over here, right near the end of September, September 27th, 28th. Looks like the time frame for the end of the next downside move. Again, it could be mild and only take out this last low that was right around 38.86, or it could be much more severe and take out way down there below that 36.36 level. We don't know. All we know is that is a period of risk and likely to give you a very large decline. That's what I have on the stock market today, and that is the end of this show. I hope you found it unbelievably illuminating. Please do see our full analysis by becoming a level 1 to 4 member. And remember, we have that special going on for level 1 right now, $10 for the first month. What an unbelievable opportunity for you to be able to really get a good sense for the work that we do, especially if you are brand new, or maybe a free member and you want to see what's in level 1. That's it for today. I want you to be so unbelievably careful. It is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to sit